Two Bulls in a China Shop is brought to you in part by our sponsors and friends over at Manscaped, Trade Pro Academy, and Vanta Trading. Manscaped is the best in men's below-the-waist grooming with precision-engineered tools for your family jewels, and with a new and improved 2.0 version of the Weed Whacker now available, it's the perfect time to take advantage of our exclusive offer of 20% off and free worldwide shipping using promo code 2bulls at manscaped.com. As always, that is the number 2. And when it comes to institutional quality trading education, look no further than TradeProAcademy.com. In our free Discord server, you'll find instructions to take advantage of our discount with them as well. And for anyone trading futures, check out VantaTrading.com. Founded by Mr. W. Banks and Baba Yaga, they provide a ton of educational content with the focus of teaching aspiring traders how to build a repeatable, profitable process. Our exclusive discount code for Vanta can also be found in our free Discord server. We'll have all of those links and more in the episode description. Thank you for listening, and I hope you enjoyed today's conversation.
You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Hello, everybody, and welcome to the Midweek Update. I am your host, Kyle, and joining me in the shop is Erik from ES Invests. Thank you, Erik, for that timely interjection. If you'd like to reach out with your suggestions, corrections, trade ideas, or even just say hi, you can do that via email at 2bulls at financialineptitude.com, or you can join that free Discord server. A bunch of amazing people gathered to share our struggles and lessons learned with other like-minded market aficionados. All right, blow through the business stuff so we can talk about the stuff happening today, because there's a lot. How you been, man? How was your day today?
I got upset because as soon as you said blow through the business reviews, I thought you were going to say blow me, and I got excited. But then...
Is that what that sound was, hitting the desk?
It was, yeah, and that's exactly it. No, unfortunate.
Never mind. I'm just going to move on.
Damn it.
How you been, man? I remember the last time we talked, you were talking about your Apple, an Apple trade. You mentioned a couple different times. You still holding that?
I am, but what I'm also holding is a new pickleball racket that I got, because now I'm going to be a professional pickleball player, I think.
You're not getting into that too, are you?
Dude, I cannot tell you how sad and lame of a game it is, and juxtaposed how unbelievably fun it is. So me and a bunch of my Marine buddies that are, late 20s, early 30s, all in good shape. We go to this court on the weekends and we just slay all of the 50 and 60-year-old ladies out there with sun visors without any regret. I mean, we're slamming everything we can. It's the greatest.
Okay, that sounds like fun.
Dude, so much fun.
When I was in the military, it was all about racquetball. We played a lot of racquetball.
That's same. I love racquetball, and I still would prefer racquetball. I bet it's kind of like chess, where I bet you I could beat you, and then
I bet you'd smoke me.
Because I really like racquetball, but I would definitely pick racquetball over pickleball without a doubt, because there's always like a risk of pretty serious injury in racquetball, man. Like, I've gotten caught accidentally. It's typically an accident, but I got caught right in the eye.
Oof. And don't wear your eye protection?
No, I don't do that. And
I wear them on the back of my head, because I've had that ball come around.
Right, gotta protect those eyes. Dude, it's like the people who wear a helmet and they unbuckle it on a bike.
Oh yes. What's the point?
What are we doing here? But yeah, when I got hit in the eye, it literally felt like my eyelid was like inside out. I kept asking my friend, I was like, is my eyelid inside out? He's like, no, man, it's like normal. I was just like, you sure? I was like, it feels inside out. And he's like, no, man, you're good. I was like, I don't feel so great. But yeah, anyways, racquetball is nice because there's always a bit of danger, and then there's always a bit of contact. Like if you're skimming ahead of the ball and somebody's in the way, you could still check the shit out of somebody. Whereas not so much in pickleball, but still a big fan.
There's also something super satisfying about hitting one of those like shots that dies in the corner and watching a guy try to change directions and snap an ankle.
I love that. I honestly think what I love the most is when somebody is attempting to like volley it higher and higher, and you're just placing it in the far back corner, and they have to run back there, and you just know the only thing you're attempting to do back there is survive. Like you're just trying to survive, and you can keep dropping it back there on somebody. That's kind of a terrifying feeling. I know it very well. One of my college professors during my undergrad used to ruthlessly hit me and my buddy with that. Very frustrating.
Oh, yeah. Yes, I know exactly what you're talking about. Or the ones that I used to have a shot that could hug the wall really nicely.
Yes.
And those are so hard to hit.
Yeah, for those, I actually do that on the serve pretty regularly.
Yeah.
And what I like to do for those, I literally put the racket against the wall and I just slide it on the wall.
Oh, smart.
Yeah.
All right. Well, enough racquetball talk. Let's talk about Apple, man.
Yeah. Well, you're the one that highlighted the Apple foray into what? AI? They're working on some AI tools, but I mean, I was just looking at my trade, and it's funny because this is probably my longest trade of the year. I've been in this for 70 days now. I entered on the 10th of May.
What's your typical hold period?
Vast majority, overwhelming majorities within 30 days this year. Like I would say if I cut this trade out, my average holding period is probably like 12 to 14 days.
Oh, wow. Yeah, actually Purdue is the one who shared this in our Discord.
Thanks, Purdue.
I guess the project is codenamed Ajax, but basically they're just trying to make their own version of ChatGPT. They call it Apple GPT.
Yep, got to do it. That's super smart. It's one of those things that even if you can't make it great or whatever, especially somebody like Apple, they have a lot of brand recognition, and being a competitor in that space is essentially going to be an expectation. And you got to imagine they have something in the books, man. Like when you're working with something like Siri, right? Like not that that's AI, it's more a virtual assistant, but that's not a far cry from AI.
No, they're trying to improve that. Yeah, exactly.
And I'm sure that they've used that as some sort of launch pad to kind of forecast out AI possibilities. So my guess is they probably have some cool stuff cooked up ready.
I'm actually surprised they haven't bought another AI company as big as they are.
That's a great question. I don't know. It starts to get kind of confusing with like the anti-competition clauses and whatnot.
Mm-hmm.
And I wonder what that's going to look like for AI specifically, but it's a good question.
So what's your plan with what is your trade on Apple? I don't remember.
Right now I'm long the 17 Nov 130 calls. When I got them, they were like a 80 delta. Now I'm pretty sure they're a 1 delta. Let me double check.
So you bought
they're a 90. They're a 93 delta. They've actually come down. The deltas come down a little bit because of time. So but that for a while they were like a 97 delta. So I thought that they just bounced up more. But anyways, yeah. So I have those. I got them for 47.45, and right now they're trading for 67.50 ish.
Not bad.
Yeah. So on each contract, it's a pretty meaningful, at least at this point, it's a pretty meaningful gain. It's like 42% return on the long.
Mm-hmm.
And I'm also short the 28 July 190 call at 246. That was a 42 delta. Now that's a 67 delta. We're slightly in the money, but we still have about 75 cents of extrinsic value. So they're trading for 615. That'll come down to 550-ish, something like that.
Mm-hmm.
And then I'll be able to roll those out probably 2 weeks, 3 weeks to the 195. I'll gain another $5 of upside basis as well as a small credit. So I'll continue to make money on the short call side of things, collecting some theta. And it's coming up on the management window though. Like I have right now, it's still how many days to expire?
Said November
121. Yeah, so I still have 121. So I got about 60 days left in this trade before I need to do something with it.
Mm-hmm.
So I will probably continue to hang on to it as long as it's behaving properly, but I'm mostly using support and resistance and moving averages as my stop. I almost got stopped out actually on these 2 days, on the 10th and 11th, when we had that little bit of a pullback. That was close to where I was going to be triggering. That's using the 22-day, since price had closed below the 9-day, fell below and it like touched the 22-day. But with everything still positively sloping, I kind of gave it the benefit of the doubt. So, but I continued to slide up my stop because it's made a shit ton of money. So
Yeah, I protect those gains.
that and the move has already been pretty incredible. If you think
Yeah,
about like the move from entry when I got in, it was 173. So what is that? 173 to 198. So it's like a 15% move.
damn, yeah.
Yeah, like 2 months. So yeah, it's overall pretty healthy move.
Yep. Well, I have a paper trade we can talk about. I did this as part of my homework for the mini series that we've got coming up on options, which I don't know that we've talked about that on here. I think I mentioned
I
it
don't
on
think so.
the weekend show.
Yeah.
Basically, you're teaching me and Penny Lane Blaine from the Penny Lane podcast more about basically options, like helping us develop our plan and come up with some tradable ideas. So one of the things, because we've been talking a lot about IV on this midweek update lately.
Hmm.
So I've been monitoring some stuff. I think we talked last week about some of the stocks I was watching, but I took a trade on Tesla. I actually took two of them. Basically, a short straddle going into the close today as an earnings play, and then I also did a strangle because I wanted to see how the two performed. Like, how does a straddle do? How does a strangle do? And then I'd use the 310 calls and the 280 puts on the straddle legs. So let's say the 295 or 292 half strike. I sold that straddle for $21.62, and the strangle was $10.22 credit.
And what led you to do straddle and strangle?
It was just because I want to see the comparison of the two. I picked the legs based off of Delta.
Yeah, sorry. I guess what I was getting at there is like, what are you expecting to see? That would have been a better question.
I just want to see if the strangle has less risk, maybe.
Don't be risk averse.
Like with the wider range that you're selling, where for something to get into the money, like you need a much bigger move for it to really hurt you.
How do you define risk in this case?
Basically, just an event where the price goes well against you.
Okay.
So rather than trying to cap the upside or cap the downside, I was just curious if, I may be sacrificing some of the profit potential by going with the strangle route, but does it give me less risk in general? Is kind of what the idea was.
I see. And what's your hypothesis? If you had a guess on the outcome, not knowing what it is yet since it's on, what's your guess?
My guess is that the strangle is going to be more consistent. It's going to be less volatile. It's going to have less return potential, but it's also, I think it should have less risk too because of that. But at least that's the thought.
You mean a lower severity in terms of like max loss,
Yeah,
less risk in terms of the
exactly.
performance of this? Got it. Okay. Got it.
I mean, typically when you're doing stuff to hedge, right, you're capping your upside, and I feel like that's probably what I'm doing here. I'm capping my upside to try to minimize the risk of a catastrophic event.
Is it, you mean with a short strangle or with an iron fly?
With the strangle versus just an at the money straddle.
How are you capping risk in the strangle?
I guess you're not. Just
Yep, that's the correct answer.
it should be less of it though, because you have a further away point that it has to hit to be able to start going against you, right?
Sort of. And that's why I was asking kind of the way you think about it, because to your point, true. In order for that short option to fall in the money, the underlying has to move further against you.
Right.
Conversely,
close to a 10. Oh, yeah. Sorry. Go ahead.
Yeah, conversely with the straddle, you collect way more money.
Yes.
So while you will have a wider break even point for the straddle or for the strangle, if you still get essentially commensurate really big move against you, you will be slightly less impacted via the strangle, but not tremendously so.
Interesting. And that's kind of what I'm starting to wonder the more I look about it and think about it. But I don't know. I like seeing things on paper.
Yeah.
See how the hypothesis comes out.
One of the other things that I think you should take a look at is capping the risk with far out of the money wings.
And I thought about that, but I think we talked about that quite a bit too. Where I don't know that it's worth worrying about those one-off events when ideally what I'd be doing is taking 20 or 30 of these things, and the odds of all of those going against you is astronomically against, right?
Yep, I agree with that. The way that I think about it is, for example, if we look at Tesla earnings now, right? So
Mm-hmm.
Tesla closed at 291.26, had an expected move about 20 points, and it's down to 278. So we're still within tolerance.
Yeah.
Now, let's say in your scenario, we sold the 292 and a halves.
Mm-hmm.
And what did you say you collected for those in total?
$21.62.
2162. So if we look at the risk profile of your trade, essentially, if we get a massive move, and let's say we run up to 330, you have a $1,600 loss at expiration. And commensurately, if we fall down, let's say we go like 50 points down, so like 220 or maybe 230, you would have like a $4,200 loss, depending on where you see the maximum risk of the trade.
Mm-hmm.
So one of the things you can do is you could say, okay, what do I think the probability is that we move to whatever number makes me uncomfortable? So if we go to like down to 140, the loss at that point is $13,000.
Yeah.
My guess is that wouldn't be super swell.
No, that would not be fun.
The probability of hitting that is super, super low.
Yeah.
But what you can do is you could say, well, I still don't like the possibility of us having that move, and we could do some study essentially on the proclivity of it to make that move. Or you could say, well, maybe I'm going to cap my risk to the downside at like 230, which is like 50 cents or whatever. And I'll cap my risk to the upside at also something that's super far out of the money. To your
Okay. So
point,
okay.
to your point, it's not efficient and it's a drag on returns. And I actually think in general, that's not the way that I would go personally. However,
No, but for the price though of like a 230 strike, I think the put right now at close was like 16, 17 cents. Like
bingo.
for that price, it seems like it's worth the protection.
And that's exactly it. And the
Yeah.
way that I assess it personally is for something like Tesla, I have no qualms adding wings because
Mhm.
Tesla moves. Tesla moves. Whereas if I'm trading something like GE, I'm typically not adding wings because GE on earnings tends to move very little.
Yeah.
So even if you sell an at the money straddle, so for example, if we look at like the 28 July at the money straddle right now, you would collect $5.60.
Yep.
And if you wanted to buy like a 10 delta wing, you'd give up 60 cents. So you're giving up 10% of the trade just to buy wings on something that doesn't really move. Over time, that really starts to serve as drag. So it's kind of a bastardized approach, to be honest, to hedging, because it's like carrying a gun, right? People will say, like, if you're going to carry a gun, you should always carry it because you never know when you're going to need it, right? That's the same idea with hedging.
Yeah.
You never know when you're going to need it. So to try to do this qualitative game that I do because I'm being cheap is dangerous. But
Right.
I always juxtapose that against the move potential to make an informed decision.
Mm-hmm. No, that makes a lot of sense. It's funny you mentioned GE because that's one of the other ones I'm tracking.
Yep.
I was curious though. I missed a date on my tracker. I was curious if there was a way to go back and look at IV on a graph to where I can go back and try to figure out where that is.
Yeah, definitely. I don't know. I don't think I sent it to you. I use Thinkorswim, so I wrote a think script.
Oh, you did send me that, I think. Yeah.
Yeah. Okay. Yeah, because you should be able to plug that into Thinkorswim. It should go on the studies section of so it should be charts, like the primary tab, sub tab, and then in the top right there's studies. You go to studies, add new study. You go over, switch over to ThinkScript, drop that in there, and then you can toggle with the time frames. But I like to use essentially 1 day, 5 day, 30 or 1 day, 7 day, 30 day. So kind of like over the course of a week. Yeah.
And then the last thing I think I wanted to talk about was actually the Microsoft, because that's what got me super excited, was watching the price of straddle that I quoted on July 12 just screaming up. And I think some of the news that they announced today might have been what was kind of causing that IV run up, because it kind of died
Yep.
off a little bit today.
Well, realistically, there's actually a pretty massive spike in IV going from the 17th
Yeah.
to the 18th. 17th IV, we can use, let's use 30 days. So 21 day HV, which is 30-day IV. So that's 22 points. That really didn't move. That longer duration HV, it went, 22 points to 24 points. But the shorter term IV skyrocketed. So, for example, 5-day went from 10 to 22. And then even more so, 2-day went from 0.07 to 0.42. So the move definitely started on the 17th. It kept flying on the 18th. And then today it actually went up even a bit still from day over day, went up 15 points on HV for the short term.
Yes, it did.
Yeah.
Yeah. Well, I mean, because I rewrote my trade management for the other paper trades that we'll discuss on the next options miniseries episode. But I originally had written down like take profit and risk management, 25% loss. Then I close the position. Days to expiration gets less than 1. Then I close the position, and then 50% return or more. Then close the position as measured from one day to the next, or as measured at the end of the day. Close it the next morning. After seeing Microsoft, I was going to go back and rejigger that to 100%, 50%, thinking that, oh shit, is this normal? But looks like maybe that's not quite so normal.
No, it's not. And you're definitely seeing like a pretty significant catalyst driven event, but it's not, I mean, it's not abnormal. Like if I look at the chart on periods where IV was surpassed by HV, specifically for Microsoft, it's semi-frequent. So if I look at even just the past 30 days, I see 1, 2, 3, 4, 5. Yeah, I mean a bunch of days over the past 3 months. I see quite a few instances where it was surpassed. So yeah, it's unlikely, but it's not like supremely unlikely.
Is it worthwhile using IV compared to historic volatility as an exit parameter or entry parameter?
I would want to use both. Like I think, yeah, because the thing is when we're trading straddles, we're delta neutral, should be. So what we're trying to do is capture an expected spike in historic volatility relative to implied. So the relationship between those two is really where the trade thesis is.
Interesting. And I think I remember Rich Friesen talking about that when he was kind of discussing like his strategies when he was trading in the pit back in the day, looking at when it's low versus when it's high and having different strategies to deploy in those different scenarios.
That's pretty common if people are talking about IV or IVP itself. Whereas talking about the variance risk premium in this scenario is slightly different, but yeah, it's the same idea.
Okay. Anywhere else I can go to learn more about how to utilize that?
The variance risk premiums or trading options around earnings.
Any of the above.
Yeah, so I'll throw a link in. I just did a video recently on trading options with earnings, which covers variance risk premiums. And then I'll throw in a second video, which directly covers variance risk premiums, what they are and how to trade them. That's really what this stuff is that we're talking about.
Awesome. Thanks for sharing that.
Yep.
Anything else to touch on before we wrap up?
No, sir.
All right. Well, that's going to take us to the end of today's episode. Thanks everybody who stuck around to the end. And thank you, Erik, for sharing insights as usual. If you'd like to know more about how he trades, make sure you check out his YouTube channel at ES Invests and check out those links in the episode description. Be back soon with another exciting episode. Until then, share this podcast with the world like a tech CEO talking about AI, and take care.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks and the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.
Share this podcast with the world like a tech CEO talking about AI, and take care.
Medium.
Yeah, you got a better one?
Well, I thought you were going to have a good one.
Shit.
Oh,
mm,
share this like the priests share altar boys.
Oh my God, no.